Today we're going to talk about the allowance for doubtful accounts, how to actually apply it throughout your accounting cycle. So remember that under the direct write-off method, we violated GAAP because the determination of being uncollectible may occur in a different period than the actual sale. And so our revenue, which is the sale, is not being matched to the bad debt expense, which was created in the direct write-off method. In the allowance method, we're using the same accounts, but we're accounting for them differently to ensure that we are actually hitting GAAP. So management will typically calculate the percentage of current receivables that are estimated to be uncollectible. This is called the balance sheet account because I'm starting with my total accounts receivables. And you don't have to determine how this is done, but basically it's done on past experience based on the rigidity of your background checks into customers, etc. But essentially, they'll come up with a percentage. On average, 3% of our receivables are not collected per year, something like that. Okay? It can be applied in two different ways, and I'll show you an example of both, either by total receivables balance or by grouping by age. Now, the aging account or the aging schedule basically means that I take my accounts receivables and I break them down by how old they are, how long they have been unpaid. We know that the longer that an account goes unpaid, the less likely it is to be collected. So the formula, so to speak, and the methodology doesn't change drastically. It's just whether I take all of the receivables as one batch and apply one single estimate to it, or whether I break down the accounts receivables by age and then apply different percentages based on their age. Most companies would look at some sort of aging schedule because it is a little bit more accurate. And there are other types of methods to calculate the allowance for doubtful account, the net realizable value, but they are less reliable, and that's why we stick with this balance sheet method. So I'm going to skip through these slides and in fact actually go over to my other video that I created through Powtoon to kind of explain this. You can watch this video online at YouTube as well if you want to rewatch it. Today we're going to look at the accounting for the allowance method. As you recall, businesses have many different accounts receivables. When a business offers credit, any one of these receivables might be uncollectible. Of course, if I knew one customer wasn't going to pay, I simply wouldn't sell to them on account. Instead of focusing on who specifically won't pay, I decided to aggregate all of my accounts receivables and determine how much I will not be paid. Imagine I have 500,000 total AR. The first step is to apply the percentage uncollectible to those total receivables. The percentage uncollectible is given to you based on past experience. So imagining it's 3%, 3% times 500,000 gives me 15,000, which is the ideal balance. So I know that I want my allowance for doubtful accounts to have a $15,000 credit balance because it's a contra asset. But the problem is I almost always start with an existing balance. So how do I get from that existing balance to my ideal balance? Well, using your debit and credit theory, step 2 is simply comparing the ideal against the current and calculate the amount of adjustment you need to bring about your ideal balance. Once you've determined the adjustment, you simply create an adjusting entry for bad debt expense and AFDA appropriately. What happens when you have a starting balance other than a credit or one that's larger? There is no difference. You simply calculate the same way you always would. Of course, your entries will change accordingly, but they will always include AFDA and bad debt expense. So now we're going to take a look at BE87 if you want to take out your textbooks. And this is just how to calculate the allowance for doubtful accounts. So in this problem, Quinshan Limited estimates 4% of their total receivables will be uncollected, 4%, and their accounts receivables at the end of the year are $250,000. Question A asks you to determine the required balance in the allowance for doubtful accounts and the net realizable value. So the ideal balance for AFDA is calculated as 4% times 250,000 or $10,000. The second step is to figure out what our current balance is, and that's given to us in Part B. The allowance for doubtful accounts has an unadjusted, meaning prior to this adjustment, unadjusted debit balance of $1,500. So AFDA current is $1,500 debit. And keep in mind that the ideal is always a credit because it's an allowance, because allowance for doubtful accounts is a contra asset. So how do we record the adjusting entry? Well, we always know that the adjusting entry is going to involve AFDA and bad debt expense. In this case, I need to take a $1,500 debit and change it to a $10,000 credit. How would I do that? I would credit AFDA, usually lowercase the f. AFDA will have to be credited for $11,500. That will give me a new credit balance after this of $10,000. But I always have to use bad debt expense as well. Notice that I'm not calculating bad debt expense. I'm calculating AFDA. I'm simply putting bad debt expense to balance out that transaction. Okay. Part C of the question asks me, well, what if the AFDA balance was not $1,500, but was $500 credit? Well, again, this is just using your basic credit and debit theory. If I have a credit balance of 500 and I need a credit balance of 10,000, I'm going to credit AFDA for 9,500. And then whatever I've gotten there, I'm simply putting into bad debt expense appropriately. Now, it could happen, and it's very odd, but it could happen that you might have an actual larger starting balance. Let's say you had a, and this is purely hypothetical, this isn't part of it, part of the problem, okay? Let's say you had AFDA of $15,000 credit. I'm not going to get into exactly what this means. It has some implications, but it's possible that my current balance is 15,000. My ideal balance, however, is 10. Well, it doesn't change the way I do things. I'm still going to adjust from 15,000 credit to 10,000 credit. How do I do that? Well, in this case, I would have to debit 5,000 out of my AFDA. That would take my $15,000 credit down to a $10,000 balance. And my other account is always bad debt expense. Doesn't matter if it happens to be on this side. Again, that's kind of odd because you normally wouldn't credit an expense, but we are determining the FDA and then we're just filling in or balancing the transaction with bad debt expense. So this is a possibility. It's rare. It actually means something bad for the business, but it is a possibility to be aware of. Okay. Now let's take a look at what an aging schedule is. If you look at problem BE85, you'll see that their accounts receivables total is 400,000, but they break them down into different time periods. So 0 to 30 days is $260,000 worth of accounts receivables. And for that particular amount, I'm just going to put days over here. and amount. Okay. They have a different estimated percentage for each amount. So in the 0 to 30 days, only 1% are expected to be uncollectible. Once it goes beyond the 30 days, of which they have 70,000, they expect a little bit more to be uncollectible, and that makes sense. The longer it goes unpaid, the more likely it is to become uncollectible, or the less likely it is we're going to collect it, however you want to say that. And then 90 days plus is 20,000. So this is the aging schedule that they give you in the book, and the process really doesn't change. I take the amount and I multiply it by the estimated percentage. Okay. So 265,000 times 1% gives me $2,650. That's my amount that I expect not to collect. Okay. The 70,000 times 4% is 2,800. The 45,000 times 10% is, of course, 4,500. And the 20,000 times 20% should be 4,000. So I'm applying the estimates to each line appropriately. Then I add all of these numbers up to get how much my ideal is. And I'm just going to So 2,650 plus 2,800 plus 45,000 plus 4,500 plus 4,000 equals 13,950. So rather than simply applying it once to the whole amount of accounts receivables, I have different estimates. I apply them. But from here on out, it's the same process. Now that is my ideal to determine how I go about adjusting my account. You'll see in the book, it says let's assume, sorry, it's not part of the problem. Let's assume a current balance in AFDA of $3,000 credit. Okay. In that case, adjusting entry would be to get $3,000 credit balance to $13,000. I'm going to adjust or credit AFDA for $10,950. And then I'm simply going to debit bad debt expense for the same amount. So that's how to calculate the bad debt expense adjustment at the end of the year. Now, going forward, how do we use this? So what we've essentially done is created a pool called the AFDA of money that I don't expect to collect. Remember that I don't know exactly who's going to be in that pool. I just know that that's the pool based on experience that I don't expect to collect. In the next period, when it comes time to determine that I actually can't collect my account, rather than using bad debt expense because it might violate matching and because I already recorded my bad debt expense, then I simply take it out of the allowance for doubtful accounts. So when I do an uncollectible account, when I write off an account, I simply debit allowance for doubtful accounts, which lowers the balance of my AFDA, and I credit accounts receivable to wipe out that balance. So it no longer looks like I have anybody owing me anything, and the AFDA is adjusted to show a true value. Now, it is possible that sometimes a customer will pay after the account has been written off. Oftentimes people want to salvage their credit scores, so they actually will pay if they can. If that's the case, then I have to reverse what I just did. I have to first put the accounts receivable amount back, and I have to put the allowance for doubtful accounts back in. Remember, I took it out because I assumed that that was part of the amount I wouldn't collect. Turns out it isn't, but there is still an amount that I won't collect, so I have to put that back in. And then I simply record the cash and the accounts receivable appropriately. So you're actually putting it back into the account and then getting rid of the accounts receivable, but you have to do this in 2 steps. This exercise is relatively large. We just did BE 8.5 and 8.7 together, but I really do want you to take your time and practice this very carefully. The optionals, of course, are strictly optional. They're just additional practice if you want to. And keep in mind that the problem B set is also online for you to take advantage of if you want additional practice.